Let me ask you something. What's the safest place you can think of to put your money? A bank, right? Not the stock market, not crypto, not some guy on the internet selling you a guaranteed return. A bank, specifically a savings bank. The boring kind, the kind your grandparents used, the kind the government literally created to be boring. Yeah, about that. Because today we're talking about the time America's safest, most boring, most government-backed financial institutions completely destroyed themselves. Not through fraud, well, some fraud, but mostly because of math. Specifically, math that everyone could see, nobody wanted to admit, and Congress actively made worse while patting themselves on the back. Welcome to the savings and loan crisis. The financial disaster is so mundane, it doesn't even have a cool nickname. And yet it cost American taxpayers somewhere between $124 billion and $160 billion. Nobody can even agree on the exact number, which is somehow the most on-brand detail of this entire story. Here's where it starts. 1934. The Great Depression is still fresh. Congress creates these things called Savings and Loan Associations, S&Ls, or thrifts, if you want to sound fancy. The idea is almost insultingly simple. You give them your savings, they give you a slightly higher interest rate than your mattress, they take that money and make home mortgages. Fixed rate, long-term, boring, safe. The government insures the deposits. Everyone goes home happy. And for decades, it actually works. By 1980, there are roughly 4,000 of these thrifts sitting on $600 billion in assets. About half of all home mortgages in the entire country run through them. Half. These aren't risky hedge funds. These are institutions so conservative they weren't even allowed to offer checking accounts. The safest investment in America. It was not. Here's the problem nobody wanted to talk about. S&Ls were doing something called a duration mismatch. They borrowed short, your savings deposits, which you could pull out any time, and they lent long, 30-year mortgages at fixed rates. That works perfectly, as long as interest rates stay flat, as long as the world doesn't change, as long as nothing weird happens. Something weird happened. 1973. Arab oil embargo. Prices spike. Inflation creeps up. Nobody panics yet. 1979, Iranian Revolution, second oil shock. Now inflation is running at over 11%. Your savings account is paying you 5%. You're losing money by saving. And the S&Ls? They're sitting on mountains of 30-year mortgages they wrote in the 1960s at 5 or 6% interest, while now having to pay depositors more than that just to keep them from walking out the door. Picture that for a second. You're a bank, you're making 5% on your loans, you're paying 8, 9, 10% to keep deposits. Every single day, you're losing money. The math doesn't work. The math never worked, and the entire industry is doing this simultaneously. By 1982, the collective net worth of the U.S. S&L industry had fallen from 5.3% of assets to 0.5%, essentially zero. At the aggregate level, the industry was insolvent. Over 400 individual institutions holding $220 billion in assets were technically bankrupt. Not struggling, not facing headwinds, bankrupt by the numbers. And here's what Congress decided to do about 415 technically bankrupt banks. Nothing. Because the Federal Insurance Fund, the FSLIC, had already admitted in 1985 that it only had $4.6 billion on hand against acknowledged losses of around $20 billion. It couldn't pay depositors even if it wanted to. So instead of closing the insolvent banks, they just let them stay open. Regulatory forbearance. That's the official term. The unofficial term is, we are absolutely aware the building is on fire and we are choosing to pretend otherwise. Economists who've gone back and studied this agree. Mid-1983 was the moment. That was the window to close the zombie institutions at manageable cost. Congress did not take that window. More than half of the eventual losses were just compound interest piling up on losses that already existed in 1983. They didn't create a new disaster. They just watched the existing one get more expensive every single day. But wait, it gets worse. Because in 1982, while the industry is quietly insolvent, Congress and the Reagan administration had a brilliant idea. What if we just let them do more stuff? That's the Garn-St Germain Depository Institutions Act, signed October 15, 1982. And if you want a single quote to summarize the attitude in the room, Reagan, upon signing it, said, "And I am not making this up. I think we hit the jackpot." Narrator voice, they did not hit the jackpot. What Garn-St Germain actually did was hand a loaded weapon to institutions that were already on fire. Commercial real estate lending up to 40% of assets. Consumer loans, 30%. Commercial loans, 10%. Loan-to-value ratio limits, gone. Interest rate ceilings, gone. Net worth requirements, cut from 5% down to 3%. And the supervisory staff to oversee all of this newly unleashed risk-taking? The Federal Home Loan Bank Board had approximately five enforcement attorneys through 1984 for thousands of institutions across the entire country. California, never one to do things halfway, passed its own version in December 1982 called the Nolan Bill. It said California chartered S&Ls could invest 100% of their deposits in literally anything. Anything at all. And people wonder how fraud happened. From 1982 to 1985, thrift industry assets grew 65%, more than double the growth rate of commercial banks. You know how they grew? Zombie thrifts, already technically insolvent, started offering above-market deposit rates to suck in new money. Brokered deposits, hot money. And then they took that federally insured cash and threw it at commercial real estate deals, junk bonds, land speculation. The go-for-broke strategy, literally. If the bets paid off, they might survive. If not, well, the depositors were insured and the executives had already paid themselves very well. This is the part where we meet Charles Keating. Pay attention to this name. Keating bought Lincoln Savings and Loan in California in 1984. By 1989, he'd grown it 5 times over. Commercial real estate, equities, all the greatest hits. But here's the special move. Lincoln's staff sold bonds issued by Keating's parent company, American Continental Corporation, directly to Lincoln depositors over the counter. Elderly depositors, people who thought they were buying something safe at their safe bank. These bonds were not insured. When Lincoln collapsed in 1989, 23,000, mostly elderly customers, discovered that their retirement savings were gone. Gone. Just gone. The eventual tab for Lincoln alone, somewhere between $2.6 and $3 billion to taxpayers. Sources disagree. Records were, shall we say, not meticulously maintained. But Keating wasn't operating in a vacuum. He needed protection. And protection he bought. $1.3 million spread across 5 United States senators. Dennis DeCanoni, Alan Cranston, John Glenn, John McCain, Donald Regal, the Keating Five. In April 1987, these 5 senators summoned the head of the S&L regulator, Edwin Gray, to a meeting and strongly suggested he ease up on the Lincoln investigation. He paid $850,000 to Cranston alone. $850,000. Gray was replaced. The new chairman, M. Danny Wall, quietly dropped the Lincoln investigation. Wall would later resign in December 1989 specifically because he hadn't acted on Lincoln. By then, it was too late. Every month of delay had added more losses, more people's savings evaporating, more taxpayer money that would eventually have to cover the gap. And the political fallout? The Senate Ethics Committee investigated all 5. Cranston received a formal rebuke. The others got lesser findings. Keating went to prison. Eventually. By 1987, the FSLIC insurance fund was declaring itself insolvent officially, with a deficit of $3.8 billion. Congress recapitalized it slightly, then continued watching the problem grow. In 1988, the absolute peak year for failures, more than 40% of all thrift collapses happened in Texas. Lone Star State, ground zero. When the RTC eventually started auctioning off all the bad real estate these banks had accumulated, Texas office vacancy rates hit 30%. Crude oil prices had already fallen 50%. The state went into full regional recession. 1989. President George H.W. Bush signs FIRRA. The FSLIC is abolished. The RTC is created. They start actually closing things. From 1986 to 1995, 1,043 thrifts failed. Institutions holding $519 billion in assets, gone, restructured, or sold for pennies. 747 S&Ls were resolved directly by the RTC with over $407 billion in assets. The RTC itself finally shut down December 31, 1995. The bill? Direct taxpayer cost $123.8 billion, per FDIC statements through 1999. Include the industry's own losses and you're at around $152 billion. Include everything the GAO counted in 1996, all direct and indirect costs, and you're at $160.1 billion. The government cannot agree on its own number. What it can agree on is that between 1986 and 1995, federal prosecutors convicted 1,072 S&L officials for fraud, racketeering, and insider trading. 1,072 convicted. The irony? The thing that was supposed to save the S&L industry, Garn-St Germain, contained a provision specifically authorizing adjustable rate mortgages. That exact legal provision, in a different era, became part of the toolkit that detonated the 2008 housing crisis. The solution became the next problem. As usual. The FSLIC itself, the safety net, turned out to be the reason zombie banks stayed open so long. Because it couldn't pay depositors, it couldn't close the banks. And because the banks stayed open, they kept accumulating losses the FSLIC would eventually have to cover. The safety net trapped the industry inside a burning building and called it protection. And raising deposit insurance from $40,000 to $100,000 per account, that consumer protection measure directly fueled the brokered deposit frenzy. More insurance meant more money flowing into zombie thrifts offering above-market rates, no questions asked. The government guaranteed it, after all. What could go wrong? Lots could go wrong. Now here's the part where I'm legally obligated to point out that none of this is ancient history. 2023. Silicon Valley Bank fails. The postmortem? Long-duration fixed-rate bonds funded by short-term uninsured deposits. When interest rates rose, the math stopped working. 41 years later, same structure, same mechanism, different asset class. Nobody blinked. Right now, today, about 31% of all U.S. banks are what regulators call CRE concentrated. Commercial real estate loans exceeding 300% of their Tier 1 capital. Total CRE exposure across the banking system, roughly $3 trillion. Office vacancy rates hit a record 20.4% in the first quarter of 2025. The extend and pretend strategy, banks restructuring troubled loans rather than taking losses, covers about 41% of maturing CRE loans. Charge-off rates are historically low. Delinquency rates are historically less low. That gap between what's being recognized and what's actually happening, that's the exact same gap that existed between 1983 and 1989. The building is on fire. We're choosing to pretend otherwise, again. And there are still 16 banking institutions sitting on more than $500 million each in unrealized losses on their securities portfolios. Unrealized, on the books, unacknowledged, just Waiting. Waiting for what, exactly? We know how this movie ends. We've seen it. The S&L crisis cost you, or your parents, or your grandparents, somewhere north of $120 billion. For what? For a safe, boring, government-insured savings account designed so that nobody could possibly lose money. The safety label was the danger, because safe made people stop asking questions. Safe made regulators stop checking. Safe made Congress think they could hand out new gambling powers to insolvent institutions and call it a reform. Safe was the lie they sold you so you'd look away. History doesn't repeat itself, but humans do keep staring at the same warning signs and deciding someone else will deal with it. That's what happened in 1980, 1982, 1987, 1989, and 2008, and 2023. The safest investment in America. Good thing we fixed that. We did fix that, right? Look, most people watching this will nod along, say wild, and then put their money somewhere because it has the word safe in the marketing materials. The S&L depositors did that too. If you'd rather understand what safe actually means before you find out the hard way, well, Money Never Learns is right here. Subscribe button's right there. The pattern doesn't go anywhere. Neither does the next collapse.